Hey everyone, welcome back to the deep dive. We're going to jump right into it today, as always,
Yeah, no time wasted here.
right into the good stuff. And today we're talking about companies holding Bitcoin.
Bitcoin on the balance sheet. Yeah, you've probably seen the headlines. More and more companies doing this.
Yeah, exactly. And today's deep dive, we're going beyond just the headlines, trying to get to
Yeah, the meat of it.
the meat of it, exactly. Um, we've been digging into a bunch of discussions with experts on this topic, and the goal is really for you to walk away understanding.
What are the big things to consider?
Yeah, what are the smart ways to do this? What are the potential risks? And are there maybe some unexpected
The
benefits
advantages,
to
yeah.
this whole approach? And we're going to be covering things like, how debt plays into all this, the importance of investor trust.
Right, which is huge.
Absolutely. And then, what the future may hold for all of this.
So looking ahead, yeah, yeah. So one of the things that really stood out from the experts we've been looking at is this idea that the biggest risk for companies holding Bitcoin.
He isn't just the price of Bitcoin.
Yeah.
Oh.
It's not just the price, right? Like Bitcoin is volatile, we all know that, but that's not actually where the big danger lies.
Not the primary danger, no. It's really more about how these companies are funding these Bitcoin purchases. So, are they taking on too much debt,
Leverage, yeah.
leverage, exactly? And more importantly, what does that debt structure look like?
And they really hammered home this point about recourse debt.
Yeah, recourse debt is a key concept to grasp here.
So can you break down why that is so important in this scenario?
Absolutely. So imagine a company borrows money, right? And they use that borrowed money to buy Bitcoin. With recourse debt, if things go south, well, let's say Bitcoin's price crashes, and maybe the company's also having some internal struggles, then the lenders, the people who loan them the money, they can come knocking and say, hey, we want our money back. And they can seize not only that Bitcoin that was bought with the loan, but they can also go after other assets of the company.
So it's not just limited to the Bitcoin itself.
No, and that's the crucial distinction. It can spill over and really threaten the whole business. So you've got Bitcoin dropping in value, which hurts, but then you've got lenders potentially taking even more from the company. It's a sort of double whammy situation that could lead to real trouble.
Okay, so recourse debt, definitely something to be aware of. But then the experts highlighted a different approach, this idea of non-recourse debt.
Non-recourse, yeah.
So how does that kind of flip the script on things?
Yeah, it really does. It provides a sort of layer of protection. So with non-recourse debt, if a company defaults on the loan, the lender's claim is limited only to the Bitcoin that was put up as collateral. They can't go after the company's other assets.
Got it. So even if Bitcoin goes way down.
Even if Bitcoin, tanks, the lender can only take that Bitcoin. They can't go after the company's factories, their equipment, their other investments. This is a big deal because it essentially creates a firewall
Yeah.
between the Bitcoin holdings and the rest of the business.
I see. So it's almost like isolating that risk,
Exactly.
keeping it contained.
Yeah, containment. It's a much more controlled approach. Now, this is where it gets really interesting. One of the panelists who actually had experience navigating, commercial banking during previous crises.
Oh, interesting.
Yeah, they shared a great insight. They argued that non-recourse debt essentially allows the company to maintain control,
To stay in the driver's seat.
even with a volatile asset like Bitcoin, because it removes that specific liquidation price,
The price where everything falls apart, that everybody's always, focused on.
Right.
And I thought that was a really powerful way to think about it. It's not just about the mechanics of the debt, but it's about how it changes the whole game in terms of managing risks.
Yeah, risk management, exactly.
Yeah. And that's something we talk about all the time on the deep dive.
You can't ignore it.
You can't, absolutely. So the panel's big takeaway here was the way the debt is structured is really crucial.
Paramount, yeah.
You can have a well-intentioned Bitcoin strategy,
With good intentions.
but it can be totally undermined
Totally.
by aggressive borrowing without those safeguards.
Without the right structure, absolutely.
Okay, now let's step back for a second. Big picture,
Mhm.
because we've been talking about the immediate, financial risks related to debt.
Right.
But what about the most fundamental reliance of all of this?
The belief in Bitcoin.
Yeah, the belief in Bitcoin itself.
It all rests on that foundation.
The panel really highlighted this point.
That if something were to fundamentally change with Bitcoin,
Yeah, if it breaks.
if it were to break, if a major flaw were to be discovered, something that just undermines the whole thing, then all these strategies, they kind of fall apart,
The
right?
whole thing goes out the window.
Out the window. Now, the panel did acknowledge that most proponents of Bitcoin, they consider this to be a very low probability event,
Right.
like the ultimate black swan.
The ultimate black swan.
But it's still something to be considered.
Still got to consider it. Okay. So fundamental belief in Bitcoin seems to be a prerequisite here,
Seems to be, yeah.
which brings us to this idea of the never sell thesis.
This comes up a lot.
It does. So can you talk a bit about what that actually means in practice?
Yeah. So when these companies say, we're holding Bitcoin on our balance sheet, there's often this implicit and sometimes explicit promise to shareholders that they're in it for the long haul, they don't intend to sell. This never sell idea, it's become a core part of the investment story for a lot of these companies.
And the experts we looked at suggest that deviating from that could have some pretty significant consequences.
Oh yeah, breaking that promise, that never sell pact, could really shake investor confidence. If a company were to suddenly sell a big chunk of their Bitcoin holdings, it would send a strong signal that they're no longer so bullish,
They're not holding it for the long term.
not holding it anymore, and that would likely trigger a negative market reaction.
Right, because it undermines that whole narrative.
Exactly. So the panel emphasized that any move away from this never sell stance would require some serious justification. They'd need to communicate very clearly why they're changing course, maybe a fundamental shift in their view of Bitcoin, or a change in their overall macroeconomic outlook. For example, if they suddenly believe that the era of currency devaluation is over, which the panel viewed as highly unlikely. But the key point is transparency. Any deviation from the never sell thesis needs to be communicated clearly and openly.
Makes sense. Now, here's a question I've seen debated quite a bit online. Why do companies that hold Bitcoin often trade at a premium to their net asset value?
Ah, that's a good one. It's something that confuses a lot of people.
It does, because it's not like valuing a traditional company based purely on the assets it holds.
Right. You're not just looking at their buildings and equipment, you're looking at the potential of Bitcoin.
Exactly. So what's going on there?
The panel highlighted a few key reasons for this premium to NAV, and it really boils down to the market pricing in more than just the current value of the Bitcoin they hold. These are not just passive investment funds, they are operating businesses. One reason is optionality. The market assigns value to the idea that management can use this Bitcoin strategically in the future, maybe for acquisitions, funding new projects, navigating tough economic times. They see it as a kind of strategic reserve.
So it's almost like having a war chest of Bitcoin.
Yeah, exactly.
Yeah.
A war chest ready to be deployed.
And they also talked about this idea of monetary power.
Monetary power. It's a cool concept, right?
Yeah. So explain that one.
So basically, holding Bitcoin gives them a significant amount of unencumbered capital. They don't owe anything on it. It's theirs to use. And this could be a huge competitive advantage.
Yeah.
Then there's the idea of future productivity, the belief that Bitcoin itself could become a productive asset, generating yield or being used in new and innovative financial applications. And then, of course, there's the fact that these companies are kind of unique.
They don't fit neatly into traditional valuation models.
Exactly. So market capitalization, even though it's not perfect, often becomes the main tool for comparing them.
Yeah.
It's a bit of a new frontier, and that's part of what makes it so interesting.
It is. Now, given the inherent volatility of Bitcoin, it's no surprise that the market around these stocks can get pretty wild, right?
Oh, yeah. It can be a roller coaster ride.
And the sources we looked at talked about options trading and leveraged ETFs and things like that.
Yeah.
So how do those play into all of this?
The high volatility of these Bitcoin-related stocks has created a very active options market. You have sophisticated traders trying to profit from those price swings and any mispricing they might find.
Right.
And then you have the companies themselves sometimes using financial instruments like capped call provisions. These are often used when issuing convertible debt. And they basically act as a kind of insurance policy for the company. They limit how many new shares they might have to issue if their stock price goes way up, which helps protect existing shareholders from excessive dilution.
So they're managing that potential dilution.
Exactly. And then there are the leveraged ETFs, those 2 times or 3 times products that offer amplified exposure to these stocks.
Yeah. Those always seem a bit risky.
They're definitely risky, especially for long-term holding. They're more like trading tools. You have to understand how volatility decay works. If a stock goes up 10% one day and down 10% the next, it's a net change of 0. But with a 2 times leveraged ETF, you would have gone up 20% and then down 20% of that higher amount, resulting in a net loss. That's volatility decay in action.
So not for the faint of heart.
or for the long-term holder.
Okay. Now, the discussion in our sources then shifts to what could be the next phase of this whole thing, moving beyond simply holding
Yeah.
Bitcoin,
Making it productive.
making it productive,
Right.
exactly. So what are some of the ideas that the panel floated?
One idea that came up a lot was using Bitcoin as collateral in financial transactions. This is something that could potentially unlock a lot of value. Now, direct Bitcoin lending is very risky, as we've seen. Counterparty risk is a big issue. But using it as high-quality collateral, that's where the real potential lies.
They made an interesting comparison to the collateralized reinsurance market.
Yeah, that's a great analogy. Collateralized reinsurance has become a huge part of the financial system. And they suggested that we could see a similar kind of growth in collateralized finance built on Bitcoin. This could allow companies to manage long-term liabilities more effectively or secure financing on more favorable terms.
So instead of just sitting there, the Bitcoin is actually working for the company.
Exactly. It's an active part of their financial strategy.
And they also talked about the potential for integrating the Bitcoin treasury more directly into the core operations of the business.
Right. Imagine a scenario where the appreciating Bitcoin treasury is helping to fund research and development or expansion into new markets. That's what they call a force multiplier.
It's fueling the growth of the core business.
Exactly. That's the real power of this strategy.
So who do the experts see as the most likely candidates to adopt a Bitcoin treasury strategy in the future?
Well, they identified a few key categories. One is transformation candidates. These are companies in mature or declining industries that are looking for a way to reinvent themselves, to buy time for innovation.
So like a struggling retailer trying to find a new path forward.
Exactly. Then there are the cash-rich tech companies. These are established players with strong balance sheets, and they're looking for a superior way to manage their treasury assets. They mentioned companies like video conferencing platforms or major consumer brands as examples. And then there are the financial services companies that see Bitcoin as a natural fit for their existing business models. Think of trading platforms or payment apps.
So it's a pretty wide range of companies.
It is. And then there are the growth companies that see Bitcoin as a key part of their strategy for building a massive capital base. These are the companies that are really betting big on the future of Bitcoin.
So what was the overall consensus? Who is this strategy best suited for?
The panel concluded that while the more leveraged approaches, using Bitcoin as collateral and things like that, are probably best suited for specific types of companies with lower capital intensity, the basic treasury approach, simply holding Bitcoin as a long-term store of value that has much broader applicability. They suggested that it could be relevant for almost any company that's currently holding fiat currency that's subject to depreciation and is focused on long-term capital preservation and growth. So it's not just for a niche group of companies. This is something that could potentially impact the way a lot of businesses manage their finances in the future.
It's a pretty big deal.
It is.
So to sum up our deep dive today, it seems like this corporate Bitcoin treasury strategy has some real potential, but it also comes with some serious risks. Prudent debt management is crucial, and non-recourse debt structures seem to be the preferred way to go. And then there's the underlying belief in the long-term viability of Bitcoin itself. That's something that can't be ignored.
Right. It all comes back to that.
It does. And maintaining investor trust through transparent communication, that's absolutely essential. So it's a long-term capital accumulation strategy that offers some interesting options and a potential competitive edge. But it's definitely not without its challenges.
And the move towards actively deploying Bitcoin, making it a productive asset, that's going to be fascinating to watch unfold.
Absolutely. And on that note, here's a final thought for you to consider. We've been talking about Bitcoin as collateral on a company's balance sheet, but what about beyond corporate balance sheets? What other applications might we see in the future? What unexpected industries might start using Bitcoin in this way? It's a question worth pondering. Thanks for joining us for another deep dive.
See you next time.
See ya!